as the S&P 500 approaches its first record high since February, some investors are betting rate cuts from the Fed will help propel stocks to new highs. Is the market getting ahead of itself? Well, joining me now is Joe Davis. He is Vanguard's global chief economist. He's the global head of the investment strategy group. Let's start right there. Is it?
I don't think so. I mean, I think we have the expectation of some Fed easing in the back half of the year. Clearly, we heard Chairman Powell talk about a wait-and-see mode. I think that makes sense, but we continue to expect a modest further cooling in the labor market. And I think once we see that, I think it'll be appropriate for the Fed just to take their foot off the brake a little bit.
That said, there's been a lot of focus on the fact that the yield curve has been steepening and the idea that part of what's driving the bond market, particularly on the longer end, is fiscal policy and other dynamics rather than the Fed itself. So if that's the case, should we expect higher rates for longer?
Well, that certainly has been more of a secular theme from Vanguard. You know, for roughly 2 years, we thought both where the Fed in the long run would be, as well as just average Treasury yields, would be higher today than where they were just 2 years ago, in part because of what's called our structural deficits, which mean they're compounding consistently over time. We've seen nothing that really changes that sort of thesis and outlook. It doesn't mean we're going to have alarming rises in interest rates, but the days of, where we were 4 or 5 years ago, we were of high conviction that we have left that world, and I think you're seeing greater appreciation for that.
So what does that mean in terms of how you should invest and think about investing in this environment?
Well, I think, again, what was clearly at the beginning of the year, and I think the dynamic still at play, is that you have an economy that remains fairly resilient, which is actually pretty remarkable given the headlines we've had. You have greater support from fixed income, just from an income level and a carry level, regardless of what the Fed does in the back half of the year. And then you have an equity market. I've been encouraged to see some of the broadening outside of technology, which has been just a V-shape one way for the past several years. So I think I would say at the margin, fixed income is compelling. And then I would be looking outside of tech, not because tech is in a bubble, but rather if this is an enduring expansion of the equity market, and we're going to test new highs, we got to see a broadening in participation in other sectors.
We have a White House that says there's some trade deals in the wings, that they're looking to get through this reconciliation bill in Congress. We're 2 weeks out from the self-imposed tariff deadline. How much does that factor into your outlook in the second half of the year?
Certainly tariffs and the uncertainty of the tariffs themselves and where we land has really been the biggest factor in moving some of our growth expectations, say, for U.S. GDP. We have an assumption that the tariff rate at the end of this year will be in the low teens, which is, say 13%. That was well north of the 2% we had last year, but it's certainly lower from where we had at Liberation Day and some of those announcements. So we're expecting a little bit of choppiness in the labor market because of that uncertainty tax, as we call it. I think we saw a stalling in investment and hiring for a time. The trick will, and that I think then introduces the Fed into play. But again, unless we see a wild shift further in tariff rates, it will not be enough to derail expansion this year.